Well, hello everyone. Welcome to Trading Price Patterns. My name is Barbara Armstrong. I'm a coach with Schwab. Delighted to be joining you today. And today we are going to take a walk on the wild side. And what do I mean by that? Well, I think it's always best to approach life and trading with both, a modicum of seriousness and humor. We're going to be looking at some bearish opportunities today, some things that have bonked their heads on a ceiling or a resistance area, and are kind of going ouch and coming back down off that trampoline. So that's what we're going to be looking at today. We're also, as a companion to that. So what do you do when you see something that is falling and has hit its head on a resistance level and is falling? And, I treat this as a companion class to our Monday and Friday trading a smaller account. And so we're going to be looking at verticals, specifically long put verticals and short call verticals. And we're going to kind of compare and contrast those, look at different strike widths. One of the questions I was asked was, how do you decide what your strike width should be, and why do you care? And I think those are really great questions. So we're going to explore all that and more. I've got my friend Ben Watson in the chat with us today. Ben, it's always a privilege to watch him in action, as I did in Dallas this past weekend. And I know that some of you were there with us. And he also taught trading index options earlier today. And that's always great. I was riding shotgun in the chat. Now, Ben is in the chat with us. So if you've got questions, don't hesitate to ask. I want to thank each and every one of you that's here live today. So hello to John and Backroad Bob and Marcus and Kevin and Brown Buffalo. I love some of your handles, and George and Andrew and Tony and Will and the rest of the gang. Thank you for helping bring this class to life and bring the energy to it. If you're watching this in the archives and you have questions, don't hesitate to ask. I do look at every comment put in on a daily basis, and I'll get back to you quickly. Okay, so before we get out to the platform and start looking at some different examples, know that options carry a high level of risk and aren't suitable for all investors. You have to apply for option trading privileges with Schwab, and not all will qualify. This is trading, technical patterns, this class. So we do focus on technical analysis, but other approaches, including fundamental analysis, can help us provide a more well-rounded perspective. We're also in the midst of earnings season, and this is a huge week. Over 170, 180 companies that are part of the S&P 500 coming with earnings. A lot of the big boys coming this week, and they have the ability, to influence the market, shall we say. So it behooves us to be aware of that, what's happening geopolitically, within our world, within our country. Tariffs have created some uncertainty in our market, and the market likes certainty. And so we've got all this volatility, and what do we do with it, right? And so that we're going to talk about that today and how we can take advantage of that. Know that one of the nuances or differences, because we do all our example trades on the Thinkorswim paper money platform on the Thinkorswim desktop, is that short options will never be assigned early in paper money. That can happen in a live account. Okay. Now, if you weren't with us in Dallas last weekend for the Advanced Options event and you would like to join us, Denver is coming up this Friday and Saturday. Kevin Horner lives in Denver, so he'll be joining you at the Gaylord Rockies, and Ben Watson will, as always, be leading the show. If you've never had the privilege of meeting Scott Durfee and Ray Kimbrell, I met Scott Durfee, on the long weekend in July, and that began my love affair with trading. And Scott knows a ton. He'll probably has forgotten more than I'll ever know. So if you do go to a live event, make sure you talk to Scott and Ray, because they're, a wealth of information, along with Ben, who's leading the show. I'll be in Anaheim at the end of May for the next Advanced Options workshop. And then we've got 2 market drives coming up. One mid-June in Miami, and Kevin will be there with Ben. And we'll be flying people in from all over the country for these things. And if you've not been to a market drive, we start with what's happening globally in the economy. And then we look at how that's influencing the market in general, and then how it's impacting different sectors. And then we come down to, and here's how you as an individual might take advantage of that, and we'll look at specific stocks. So these are jam-packed days. First one in Miami, next one will be in New York at the end of June. Okay, so having said all that, let's get out to the platform. Okay, so the S&P, I mean, earlier in the day, this was down far more dramatically than it is now. But, we can see year to date, we're still down, 6.5%. I mean, so we've come back a long way, because at one point we were down over 20%. And then, we can see with today's candle that we're still down almost 1%. But at one point, we were down significantly more than that today. So it's kind of rallied off the close, off the low of the day. However, this is still a live candle. So who knows where we'll be at the end of the day. The NASDAQ, kind of more of the same. I mean, we're down almost 9% on the NASDAQ year to date. But at one point, we were down about, 23%. So, it's kind of come back part of the way at least. But today we, gap down on the open. We've rallied a bit. We're still down over 1% on this index as well. But, we had this kind of diagonal resistance breakout, and then it's coming back. And, will it come back and test the ice and, be cool? Or, will it, turn out to be a fake out and break back down below? And the answer is, we don't know yet. We just don't know yet. And the Dow, similar, right? Big long tail to the downside. And today we have this candle, which, if you're not as familiar with technical analysis, you may want to join me on Tuesdays for getting started with technical analysis. This at the end, or, when we get up to a potential resistance level, is an indication that the winds of change may be upon us. And with this type of hanging man candle, you'd look for confirmation tomorrow with the index closing below the body of today's candle, if in fact it ends up, looking like this at the end of the day. But, the jury's still out. When we look at volatility, and it looks like, wow, we've come back a long way. But at 2580, we're still kind of in the nosebleed section, for where we've been over the last year. There have only been, 1, 2, and that was just for a day, 3, and this is now the 4th time where we've been up in this arena. And obviously with what's been happening of late in April, extraordinarily high volatility. And so some might look at this and say, hey, you know what? Like, maybe this is a time to focus on selling strategies when volatility is still higher than normal. Now, maybe not higher than where it was a week ago, because it kind of broke out here at the beginning of April. So April's been a very volatile month. And this makes us nervous. How do we trade when the markets are this volatile? And, I keep coming back to it's like hugging a porcupine. How do you hug a porcupine? Very carefully. How do we trade in this type of market? Very carefully. And so what we may want to do is kind of shorten our perspective or shorten our targets, maybe go for more modest gains. I really love what Ben is doing in his trading index options class. If you haven't checked that out, I was really excited about that, and I've been telling everyone about it. So get thee to that class, or get thee to the archive if you haven't already been tuning in to that one. Okay, so now that we've looked at this, let's go and look at some individual stocks. So Lulu. I don't know how many of you are Lulu fans. I just like saying Lulu. It's kind of a cool word, but Lululemon, it had a nice run here. And, when we look at the last 2 years, man, the ups and downs of life, right? Like at one time was at $516 a share. And then, it had a great fall through 2024, through August, it was hitting hard times. And, you may say, well, yoga pants are not a discretionary item, but, top of the line, very expensive yoga pants as opposed, at maybe $100 or $90. I don't know what they are. I must confess, I don't own Lululemon yoga pants myself. As opposed to the ones you can buy for $12 at Costco, is a discretionary item. And in fact, it is in the consumer discretionary category. And so it had a bit of a nice run up here until, the end of January. The market hit an all-time high back on February 19th, and it's been struggling since. And, latest earnings, dove out the window. And then it's really kind of kept falling. And then it's hit here and it's consolidated a bit. But here's our first example of something that kind of hit this resistance level that it's hit multiple times. Let me just get my drawing tool fired up here. So, once, twice, 3, 4. So it kept going bang, 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 bang. Then it came down, bang, 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 bang. And today it's lower. Now you might say, well, to be conservative, I'd like to wait for that confirmation. But we had, if you say this is our high day, we have a close below the low of the high day. If it closes here, it's closing below all of these days. And in fact, today it's down 2%. So could we do something that's kind of sort of bearish? And, and that would be selling a short call vertical. Now, if you're not familiar with this strategy, there are lots of recordings in the archives under the Getting Started with Options series. I also have an example trading plan under the Trade Management mini session playlist that you'll want to check out. But we're basically selling a call on a stock that we don't have. So we're agreeing to sell stock we don't have, or obligating ourselves to be more technically correct. So we're going to define our risk by then buying a call. And as long as this stays below the 272 or 275, whatever strike we sell, right now it's trading at 265. So if we could maybe sell the 275 call and the 280 call, could we get enough premium, for this to be worth our while? Okay, so good question. Let's go see what the answer is. So we're going to come to our trade tab. Okay, spoiler alert, we may be looking at Tesla. Yeah. So if we come out 3 weeks, does this trade more than 1 million shares a day? Well, we're at 750,000 already and we've got hours to go. If we come out 3 weeks and we come over to the put side, what's the bid-ask spread like? Well, we've got a dollar wide spread. Well, if our rule of thumb is as long as it's under 10%, we're okay. We're under 10%. So let's come out here to the 270. So that's $5. Actually, we wanted to come to the 275, didn't we? We wanted to be above 275. So 275 and 280. Now we don't have a lot of volume here, 8 and 12 contracts, and the bid-ask spread, that's like not quite $2, but it's closer. So it's still acceptable, but it's a little wider than we'd like to see. So let's come out and see if we've got less volume here and wider bid-ask spread. So we're going to stick with this. Although it's technically acceptable in that it's under $2, we'd rather see more volume here, more liquidity. It might make it harder for us to exit the trade if it's the market maker on the other side. Oh, it's supposed to be a short call vertical. Sorry, guys, you're right, because I'm going to do a long put vertical when we're done with this one. Okay, so here, if we look at this 275, that's a dollar wide, and we've got 57 contracts. That's a little wider than we want it to be. Now the 626.95 is okay, and the 475.30. But if we go up to 280 and 285, that's wide. And this stock tends to have wider bid-ask spreads. I'm not sure why. But let's see at the 280, 285. Geez, we get $1.60 for that. And it's trading at 265. And this has a more acceptable bid-ask spread. And so, like, why am I kind of jazzed about that? Well, let me just bring this up. We're going to change this to a calculator because, well, now it's 127. So let's call it 130 divided by 370. We're looking at being in this for 23 days. That's, a 35. At this, it's even higher, 150 divided by 350. And, we could drive ourselves crazy because we're live in the market. So, these numbers are going to keep popping around. That's a potential 42% return for a trade we'd be in for a max of 23 days. And we're going to close out probably the Monday prior to expiration if we haven't hit our target. We have a 31% chance of it being in the money, which means we've got a 69% chance of it expiring worthless. And so if we don't want to risk more than $500, we're going to do one of these because we're risking 350. So we're going to go to single order. And I don't know why it's not letting me do this. I'm going to have to do some finagling after the class. But what I'm going to do is we're just going to put this in to our short put vertical group. And then we'll go back in and we'll put, short call vertical group. Earth to Barb. Okay. And then we'll go in and put in our exit. And where will our exit be? At 30 cents. So now we're going to come to the monitor tab. That order has filled. So we're going to come down to our short call verticals. We don't have an exit on Lulu. So we're going to come here and create a closing order to buy this back at 30 cents. And it's a limit order, so it'll only trigger an order to sell if it goes at or below 30 cents. Okay. So that's Lulu. Now, what is the other option? Well, if we look at this and when you consider where our strikes were on this, they are at 280 and 285. So if I draw this on the chart and we move this up to 280, as long as it stays below 280, and stays below that until expiration, we have got a successful trade. Now, volatility is high, and if it goes higher, that will not work in our favor. So we've got the thing that is in our favor. I think this is May 23rd. The thing that is in our favor is that time is working in our favor because it's a selling strategy. But if volatility goes up, that would be working against us. So if we wanted to do a long put vertical, could we look at this and say, now we'll come over to the put side. So it's at 265. So could we sell the 270 and buy the 270 and sell the 265? It's already through both strikes, or close to it. We're 73 cents away from it being through both strikes. And so as long as it goes below 265 and stays there, we'd have a successful trade. But when we look at this 270, this bid-ask spread is just so wide. It's disconcerting, isn't it? So maybe we do the 275, which has, a better bid-ask spread, but lower volume. So now we're under $1. So we just have kind of wonky things happening in the market. So again, here, we'd want to put a target in, but for some reason, this is not working on my side. So we're going to go ahead and we're going to do we're going to do 2 contracts because, we're risking 238 a contract. So 2 contracts is still under $500. So the most we can make is 524. The most we can lose is 476. We're going to put this in our long put vertical group. And then we're going to compare this to the short call vertical. Okay. How do I get my watch list number to display like that? This watch list number? Okay, I can show you that. So we're going to send this in. And then what we tend to do with these is put a target in to exit at 50%. Now, if you are not seeing that number, it's because your gadget is too narrow. So if you just bring it out a bit, you can link your chart and your trade tab to your watch list, and then you can shrink it back down. Okay. Okay. Okay, so that's Lulu. And with this one, okay, Lulu hasn't quite filled yet, so this is to open. We only wanted to pay 238. It's now saying pay 242. So if we really want this to fill, we might just say, you know what, we'll give you 245. Feeling generous. That's our long put vertical, and we're going to compare to the short call vertical. And then when that fills, we can go in and put in our target. Okay, so that is Lulu. How about we look at Tesla? Now, Tesla's a little different in that Lulu, well, I guess it's similar in that this, has been kind of consolidating and is now, moving again to the downside. But with Tesla, it's more of a defined pattern of consolidation after a great fall. So if we come and we hone in here, it hit this high back in December, and it really has fallen pretty dramatically. And then, it tried to rally, came back up to around this 288 level, and then it came back down to 219. So, if I'm playing I Spy with my little eye, one of my favorite games in the world of looking at charts, we've got this double bottom pattern. But what do we look for when we see this consolidation pattern following a downtrend? We're looking for a breakout. And so far, no sign of a breakout. So, but what we do see is this thing is down 5% today. I mean, at one point it was down 6. So could it be, about to come back down? And if you were trading this bearishly, could you do a long put vertical, or could we just say, well, with the market overall appearing to be kind of pausing, could we do that short call vertical trade again? And look at something at maybe 290, above these recent highs. And if you want to see specifically, I mean, today we've got the price showing up on the chart, it's at 276, but yesterday it reached a high of 293. So maybe we want to look at something 295 or 300. Could we go out and sell the 300? So let's come to our trade tab. And if we come out to May 23rd, so 3 weeks. So if we're looking at that 20 to 50 day time frame, if I sell this vertical, I get $1.42. Now, one of the questions I had was like, how do you decide a time frame? And so this is 23 days. Well, let's come out to 40 some days. So if I come out to 50 days to the June 20th, that's double the time, right? So let's just change this. It's $5 wide. And let's see. Oh, I went to July. I wanted to go to June. Sorry, my charts are kind of wonky here. I'm getting $1.65. Like, that's not a huge heap more, is it? To come out to June, where I'm coming out 50 days and I'm getting kind of a thimbleful more. And some might say, like, I have no idea what this stock will be doing by June 20th, but I'm thinking for the next 3 weeks, it might just stay under this 300 level. I've got $23 worth of wiggle room. Okay. So if I come back to May 23rd, so what might some be thinking? They might be thinking like, hey, I'd rather do 2 trades and get $1.45 than just do 1 trade and get $1.60. And then I can adjust my strikes as I go. What's the downside is that if we're wrong, we don't have much time to recover. So we have to take that into account as well. So we're going to come, again, we're risking 350 to make, 355. So if we take $1.45 divided by 355, what's our potential return? Oops, I mustn't have done that right. 58 divided by 142 divided by 358. So that's almost a 40% potential return. For a trade, we'd be in for 23 days. So our rule of thumb, if you look at our example trading plan, is if we're in it for 23 days, we want to get at least a 23% potential return. So we're going to do 1 contract. We're going to put that in our short call vertical group. And then we can put a note that we're going to compare to our long put vertical, which we haven't done yet. But I thought it would be interesting to compare them. Now, sometimes when there's a survey in the chat, people will say, I love it when you do these comparison trades, keep them coming. And then the next comment will be, I find it really frustrating when you do this. I wish you would just tell us the best one. And, there isn't a best one. It just depends on, do you want a trade that has a higher probability of success? And in this case, this is less directional. I've got, $23 worth of wiggle room on Tesla before, when we approach expiration, that we're going to, be compromised. So that's one thing to take into consideration. A long put vertical also tends to be more directional. Now, we tend to place them in such a way that it doesn't have to move as far. So if you're really bearish, you could go out further, pay less, and perhaps reap a bigger reward. We tend to bracket our long put verticals. And by that, I mean, if it's trading at 277, which it is, we might buy the 280 and sell the 275. Okay, and here we have almost a 50% probability of it being in the money at expiration. We've got a 95% probability of it coming in, at least kissing it between now and then. And so when we look at this and we say, okay, here's my 280, and I'm going to buy this, but in order for this to be successful, it has to move down below 275 and at least stay there for a period of time. Okay, so if we're risking a max of $500, we can do 2, confirm and send. And then we're going to put in a target to get out if we have a 50% gain, and we're going to monitor it. And if we have a 50% loss, we're going to exit. And so this is we're going to compare to the short call vertical. So we're buying a short call vertical, and then we're trading. I said buying. We're placing a trade, a short call vertical, and then a long put vertical. So with this, the short call vertical, and let me expand this and then take a minute to just explain a little more fully. Okay. So with the short call vertical, our strikes are at 300 and 305. Short call vertical. So this is what I say is a kind of sort of bearish trade, because if Tesla goes down, we are happy campers. If Tesla just stays going sideways, again, happy campers. And we can even be a little bit wrong, like it can come up a bit as long as it stays below 300, still smiling. If it comes up through both of these strikes, we've defined our risks so that we haven't blown up our account, but this is not what we want to see happening. We might be crying a little tear there. Okay. Now with the long put vertical, our strikes are, say, here and here. And so we want it to go below both strikes and stay there. And if that happens, we're happy campers. Or if it just goes below and stays there, we're happy campers. If it goes up, the same way with the short call vertical, you know, we do not have a successful trade. But with the short call vertical, we have $22 worth of wiggle room with the short call vertical. You know, with this, our strikes were at 280 and 275. If it goes above 280, we've got $2. And you know, we've got a losing trade. If it goes above that and stays above that, you know, we are in deep doo-doo. Yeah, so you know, these comparisons can be helpful. Now, could we have done, if we were really bearish, could we have put our long put vertical strikes here and here? We could have. And how much would that have cost us? Less. Would have cost us less. So we're risking less, but the probability of it being successful also less. Okay. Okay. So that's Tesla and Lulu. And then have these filled. So Tesla, our long put vertical has filled. So if we come to down here to our long put vertical, it's saying it has filled, Tesla. Okay, so I'm going to highlight this. Oh, we've made $10. Woohoo. Yeah, of course, that's an unrealized gain, right? So we want to sell this when, you know, when we've got about a 50% gain. So if we got in at 250, then we are going to sell when it hits 375. And what price did we get in at? 245. So let's call it 375. So we are going to exit this if it goes at or above 375. And that'll give us about a 50% return. Now, are we leaving money on the table? Well, potentially we're leaving $1.25 a share or $125 a contract or $250 on the table. And what do you think of that? It's like, you know what? Better a bird in the hand than not. And, you know, back when I first started trading these, I hated these long vertical strategies because if I could make $250 a contract, I wanted all of it. You know how often I got it? Almost never. And so I thought, okay, maybe I need to be less greedy. And maybe a 50% return on a trade wherein for 3 weeks is pretty all right. And if you don't think it's pretty all right, then it doesn't meet your trading requirements, then don't place that trade. Now, others might say, I still would say you're being greedy. Why not just put it at 25%? Well, if we get up 25 or 30% in a few days and then it looks like it's about to rally, and this is a bearish trade, could we just exit? Could we put in a 25% target to begin with? You bet ya. Yeah. Okay, so, and again, we're going to compare this to the short call vertical. Just our reminder. Okay. So will you be making money even if the market goes down, since you'd be selling your put for a profit? So this strategy, this long put vertical strategy, is designed to be profitable if that stock goes down. And now, we have to take volatility into account and time decay and all of that also. Those things also will influence the price. But the direction of the movement of the stock. Yeah, and we can put those strikes wherever we want, but the further out of the money they are, the lower the probability of them achieving that. So on credit, so the question is, on credit spreads, you look for 80% of your max gains, and on debit spreads, we look for a 50% gain, not 50% necessarily of the potential gain. We look for a 50% gain based on the entry price. And that's just, that's just our guideline. Now, you can make your guideline whatever, but if you haven't subscribed to the Trader Talks channel from Schwab Coaching on YouTube, there's a button down in the bottom right-hand corner of your screen. You will want to subscribe to that. And I'm just going to bring it over here right now. And this is another free resource, just like going to those in-person events. I mean, you have to get yourself there, but once you're there, we provide breakfast and lunch and there's no charge to attend. These, like when you first go to this Schwab Trader Talks from Schwab Coaching, what will come up is what is currently playing. But if you come to playlists and then scroll down, and you'll see a turquoise, what we call a thumbnail. And I've started doing these candlestick patterns, mini sessions. They're, I'm trying to get them 3 to 4 minutes long. And we're just doing a collection of each one, is a different candle pattern. But if you come down here is an example trading plan for a short call vertical trade. And then here's an example trading plan for a long put vertical trade. And you can just look at this again. It's just an example. We walk through that trading plan, and then you can customize it however you like. So somebody's saying, why would anybody enter a bearish trade on Tesla when current support is at 275? Yeah, so, if we look at this, current resistance, I would say, is at 288. 290-ish, and these are ranges, right? And I'd say current support is around 219, ish. We had a low here of 214, 215 to 220-ish. So like that's a lot of room for a stock at 279 to move down to 219, to that support level. Now, others might say, well, you could look at today's low as being a support level. True. You could say, well, I see the 30-day moving average as a support level. Well, you might see that, but I don't. Not right now. It was acting as a ceiling for a while, and now it's kind of going sideways. So it's been weaving back and forth through the 30-day moving average. So I'd say the 30-day moving average hasn't been acting as support or resistance. And, so technical analysis is a bit of an art, but I would say recent support, I see it in a more intermediate term being around this 219-ish. And, I could be wrong. Wouldn't be the first time. Would not be the first time. 288 to 290, I see that as being resistance or the ceiling. Okay. So, our time is clipping away. There were a few additional things I wanted to look at. One is Dow. Now, Dow has been rolling down the hill like forever and a day. Well, not forever and a day, but since last September. So it feels like forever. If you were a cyclist, you wouldn't have had to do much pedaling. Let me put it to you that way until the last couple of weeks. And now we're seeing a bit of a panic break setting up. But it looks like it's come up, and kind of hit its head once again on this 30-day moving average, which in this instance, I'd say has been acting more like a resistance level for this stock. And so could we do a short call vertical or, something like that on Dow? How about if we look at Etsy? Oops. Helps if I could type. So, Etsy came with earnings today. We can see at minus 49 cents a share. I mean, ouch. They were expecting it to be, plus 49 cents. And it came in at minus 49. I mean, that's like a huge miss. And so we can see why it's down almost 10%, but it's been trading in this downward range. So, is volatility high enough that we could sell a short call vertical up here? Or could we do a 1 ATR trade and say we're expecting it to continue to fall? Now it's fallen further since I first looked at this, but there's another one. And then last but not least, how about our friend PayPal? Now PayPal also came with earnings, not nearly as dramatic as what we just saw on Etsy. But let's go back to Etsy for just a minute and think about it. So we're talking about a lot of demand, and this is where it's like not just looking at the charts. We've talked about a lot of demand destruction of late. People they're uncertain, so might they be spending a little less. And what does Etsy sell? They sell a lot of artsy, like really cool things. Like, so I was recently given this bottle. It says, Nana established 2023. I became a grandma in 2023. And my kid's nickname for me is the Supreme Ruler. So it says on the other side, Supreme Ruler, and established it, the year my first son was born. And somebody customized this. That could have well have been an Etsy purchase or T-shirts and things. So it's discretionary. And, obviously it looks like, that business has been on the struggle bus a bit more, right? So if you just think about it, like in PayPal, if people are spending less, then they're processing fewer payments, right? And so we can see here's another stock where this 30-day moving average has been struggling to get above. We had a consolidation here around 67, and then old floor, old support, looks like it's become new resistance. And we had this candle pattern yesterday. A hanging man is what they call it in trader speak. And then, if you want confirmation, you'd like to see it trading below the body of that day. And where are we? Right there. So might that be another opportunity for an example trade? So guys, that is a wrap for today. I love that you guys had so many questions. John said today was leg day. Yeah, leg day for me too today, John. So love to meet somebody else who enjoys working out. So on that note, if you haven't hit like, it helps move this up in the algorithms on YouTube so that more people can find this. So if you would do that for me, you could be doing not only me a favor, but you could be helping someone whom you will never meet. So helping a random stranger, and to me, kindness, it never goes out of style. So hit the like button, subscribe to the channel. Don't forget to follow Mr. Ben Watson and I in the land of X, Barb Armstrong CS and Ben Watson CS. No, we will never reach out to you with a Bitcoin, a crypto deal, or education. That's private for just a special few for a fee. That's not us. It's a scammer. And on that note, have a really great rest of your day. Up next, I believe it's Mike Fairborn talking about forecast and, what's going on in the markets. You won't want to miss that. So stay tuned, everyone. Bye for now.